This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys. I'd like to welcome each and every one of you to this monthly open house Q&A, where we will begin with a review of the markets, leaving off from last week's market report, which is when I recorded that on Friday. And as you can see here, this is a one-year daily candle chart of the volatility index for the S&P, and that's the VIX. And last week, I'll zoom in here for you. Last week, what I did is I drew my lines forecasting what I thought the VIX would do, and I extended this more or less into almost a 2-week forecast, and I said that the VIX would most likely drop to fill this little gap down here. And if you've been following along with the Market Guys long enough, you'll know that I'm excuse me, hold on, I have a little bit of a cough here. I surely hope I'm not getting that flu that's going around, but I'll do my best not to cough in your ear here. So excuse me for that. If you've been following along with the Market Guys, you'll know that I'm a big follower of gaps, and I have a set rule book for gaps, especially when it comes to the VIX. Now, you could back test this to see how accurate it is, and with gaps on the VIX fills its gaps 100% of the time. With individual stocks and commodities and even certain currencies, there's usually the 80-20 rule that plays into that gap strategy, where 80% of the time in those markets I just mentioned, 80% of the time the gaps fill, while 20% of the time they don't. Now, why is it the VIX fills 100% of the time? And that's because the VIX is not a stock. It's an oscillating index. And if I go back to, this is going back 20 years, you'll see that it stays within a range, and with the exception of 2008 and 2009, where it spiked off the charts to, up to 90 plus, the VIX stays within a certain range, usually between 10 or 11 and up to 40 to 45. So it's safe to say that when a gap is formed, the price of the VIX will most likely move back to the place that the gap was left. And so when the VIX is expected to pull back and fill that gap, it's inversely related to the S&P. Remember, so it would be safe to say that the S&P will most likely go up a bit while this volatility index is pulling back. Now, the other part of the gap rules, it's very important to understand this part, is that once the gap fills, there's an 80% chance that the price will reverse from the gap fill point. Now, the 80% of the gap filling and reversing applies to the VIX. That's not 100% of the time, like I said in the first part, where 100% of the time gaps fill, but they don't always reverse after they fill in the gaps. It's an 80% chance that it'll reverse. So that's the reason why I said the gap will most likely fill, and after it fills, it'll most likely pivot and start to go up. So as you can see, I like the VIX as a leading indicator. It's very reliable. It's a great tool for managing risk. It's a great tool for picking highs and lows in a general market. It's a great indicator for predicting market lows. And why do I say that? Well, going back to that monthly chart, when the VIX was, again, off the chart right here up around 90, when the VIX is that high, you're picking a market low. And actually, that was the market low right here. When the VIX hit 90, that was the time to, you know, sell the house, sell the car, sell the kids and the dogs, and buy stocks. And that's exactly what happened for when the VIX went from 90 and then dropped all the way back down to 15. Took about a year to do that. The whole time the VIX was falling, the general markets, especially the S&P, were rallying. Okay, so keep that in mind. Now, again, with the VIX, and I don't want to spend too much time on this, you can see that this horizontal low down here, that's the 20-year low for the VIX, which happens to also correlate with the all-time low for the VIX. So when you're weighing this into the whole equation for forecasting the market, you see the VIX so low, you have to be more defensive in your approaching the market, because yeah, the VIX could stay on the lows and the markets can continue to go up, but eventually the VIX is going to pop, and you'll see that it has almost a cycle to it where it's every couple of years or so the VIX really storms up and corrects, if you will, and at that time that's when the markets start to drop. So we see the markets still going higher. We see a lot of investor optimism coming in thanks to the Trump effect. But at the same time, I'm not going to tell everyone this is the exact high and you should sell out of every bit of your stocks. I'm telling everyone that I think it's just wise to protect your positions, especially when the VIX is on historic lows, because at any point in time, the markets can correct. I was very surprised to see the market rally today because, with the government shutdown, I had no idea how long it would last for. And I thought, well, this is certainly going to shake up investors at least a little bit, right? Well, no, it didn't shake up investors at all. In fact, if you look at the S&P, I'm switching to what the VIX is inversely related to. The S&P went up. And that's exactly what I forecasted last week because of the VIX, not because I thought, oh, there's a chance the market could drop because of the government shutdown, but because the VIX was still pulling back and it's inversely related to the S&P, you can see here that the VIX rallied up. Now, as I zoom in to the S&P, notice this is a candle that has, I'm going to zoom in even further so you can really see this. There's almost no shadow below that candle body. See, that's like a little bit of a shadow. And there is zero shadow above the candle. This is a fairly strong candle with regard to the length of the candle. But look at the volume. The volume was not higher than what it was on Friday. So there's a good chance tomorrow we'll see a smaller body candle somewhere up here, which is right, not far from where I said the market would start to peak out here. So I think you'll see a smaller body candle, possibly on lower volume. Okay, I'm going to say maybe the volume will be something like that. Okay, less than what it was today. And then I think you'll start to see a pullback in the S&P for a couple of reasons, not just because the volume is dropping, but because of this vertical leg. You see this? From this low to this high, that's a pretty steep angle. And the price action of the S&P is drawing itself quite a bit away from that 20-period moving average. That's called the price divergence. And when you have the price moving away from that moving average, you've heard me talk about the rubber band effect. That's exactly what's happening. Imagine, again, one end of the rubber band connected to the moving average, the other end connected to the price. What's happening? It's the rubber band is getting stretched. And when the volume starts to drop, the rubber band has a tendency to pull back. That's what we mean when I talk about the rubber band effect. So if you're long any of the S&P stocks, what should you do? Should you just sell them tomorrow? No, you have to wait for the pivot point to start to form and then maybe put stops below some of those stocks so that you're protecting your profits along the way. And then if it pulls back to the moving average, like I think it will, and then bounces off the moving average, it gives you another entry point a little bit lower. So in essence, what you're doing here is you're buying the pullbacks and you're selling on the rallies that are showing any weak candles or weak volume. And that's how we're playing this market the whole time. We're taking cautious longs in stocks that we're seeing good, strong signals in. We're getting out at target points. We wait for the markets to pull back, and then we get back in, and we do the whole thing all over. It's just a cycle of buying low, selling higher. And that's the strategy as of now until the markets are showing us any kind of a correction. Now, let's look at the Russell 2000. More broad-based index. Again, my lines are on the chart from last week. From the last week's market report, I said that we would most likely rally. I even had to compress the price axis here. And I said that the market will most likely rally and set a new high. Today it set another high, but I think it could still go a little bit higher before pulling back. And the rubber band effect will still apply for the Russell 2000 as well. So again, if you're taking any long positions, make sure you're protecting them with stops or maybe some options, or you're just paying very close attention to the market and the news related to the market so that you're not caught off guard and all of a sudden you wake up and the markets are gapping down because you weren't paying attention, because that's the Russell 2000. Now the Qs are not pulling back. I thought the Qs would pull back. It's following right in line with the rest of the market. And the reason I thought the Qs would pull back is because of this doji right here. See, it looks like a cross. See that? And we have lower volume today. So again, this is all going to more or less be in suit for a possible pullback later in the week as we have these wide price divergences. And again, you can see with the diamonds, there is a rally as well. Now, excuse me, with the diamonds, I'm going to review this. And that's the fan lines for those who are interested in learning how to draw fan lines. I'm going to back up a little bit and go to the monthly chart on this. A fan line, I really can't repeat this enough times because hopefully you've heard me talk about fan lines enough to where you can actually explain this to someone who even asked you, how do I draw a fan line? It's not rocket science, believe me. It's looking at a chart, scanning the chart for a very obvious low. And in this case, I picked this low for the first low. You draw that line from the very low to the next low or a group of lows where you can connect two dots. Okay, so the trend line is where you're connecting two dots, two lows, and then you're extending out. Okay, that's part one, finding a common group of lows to establish a trend. Then you take the second point in the line you just drew, or the last point, I should say, in the line that you just drew, and you start your second line from that point, and you follow the same rule. Find another low you can connect to, extend out, and then you do the same thing. On the second line, you go to the last point, and you start your next line, and you keep accelerating this. Now, if I zoom in, and I think I mentioned this on the weekly market report, but I'll say it again. This is the first time in my 35 years that I've seen 6 unbroken fan lines in a row. So these are 6 fan lines that are now holding. The first one that I drew is off the board here, so it's 1, 2, 3, 4, 5, 6. So I think by the end of this week, we could see a break in this most vertical fan line right here. And when that happens, here's the rules for fan lines. Once the most vertical line is broken, it generally drops. And this is, again, almost 100% of the time. Once the most vertical line is broken, almost 100% of the time, it will drop and fall to the next fan line in that sequence of fan lines. So remember, this is 6, this is 5, this is 4. If it breaks 6, you can almost count on, and this is where option traders love fan lines, because if it breaks the 6th fan line, they could start buying puts, and then they'll close their put positions and get out for a profit when it touches the 5th fan line. And then if it breaks the 5th fan line, they'll buy more puts again, get right back into a short position, and wait for it to hit the next fan line, which in this case would be fan line number 4 right here. And that's how we trade the fan line. So I have a video on the Market Guys website in the video library that talks about fans. And if you have any questions on that, on how to trade them, how to use them for stop areas or initiating new positions, just send me an email and I'll do my best to answer you back with maybe some pictures and clippings from my chart. So we'll try to do that. Folks, if you have any questions, you can type them in now as well. And I'm looking for any questions that come in. Okay, no questions yet, but you can type in questions. All right, now Ron says, would this be a good entry point? Okay, I think, Ron, I think you got ahead of me there. I think you're looking at F, Ford, right? Is that right? Well, let me do this. Let me just talk a little bit about one other thing before I forget, and then I'll get into your stock questions. I'll analyze your stocks. And I'm going to try, if you have any stocks that are extremely volatile, what I want to do is I want to try to draw some fan lines on this so you can see how the fan lines worked out as well. Now, before I forget, because I probably run out of time at the very end, on Thursday, this Thursday, which is the 25th, I have a web seminar that I'm doing for TradeStation clients. Now, it has to do with the cryptocurrency market. Now, let me tell you something. I'm not touching the cryptocurrency market or the Bitcoin market with a 10-foot pole. I don't find it to be stable enough for me to risk my money at this stage of my life. Maybe if I was, my 20s or 30s, I might dabble in it. But, when I traded commodities on Wall Street in the World Trade Center, when I was a Wall Street cowboy, I was taking all kinds of crazy risk in silver. Heck, I was trading gold, silver, platinum. I was trading orange juice, coffee, sugar, cocoa. I was trading the Moody Bond Index. I was trading oil. Everything I could get my hands on in the commodity markets I was trading, because it was extremely volatile. And it was like a field day, really, because we were using options to limit our risk and to leverage our positions. But what happened with the Bitcoin market is that I saw things coming in that I really didn't like, and it was the fact that there were a lot of MLM companies, nothing against MLM companies, but there were a lot of MLM companies hyping up the price with, through people who had no experience or even any licenses in the financial markets. And I saw that as a red flag immediately, because in 35 years, I've held all the licenses you can imagine. Series 3 for commodities, Series 6 for mutual funds, 7, 8, 9, 10 for options and option principal. I've held all the license. 63, excuse me, for those of you in insurance, the blue sky laws, I had them all. And now I'm looking at a market where there are literally people coming just out of college, and now they're Bitcoin experts giving people advice with no licenses. So my experience told me that eventually the SEC is going to step in, and FINRA and everyone else, and they're going to start regulating this. I said that I even had conversations with people from the SEC. They said, we're watching very carefully, and we will eventually step in. They told me this. And now they're stepping in and is crushing that market. Now, Thursday, I'm going to be talking about the futures markets that the CME and the CBOE are introducing that can be traded through TradeStation. Now, if you're again, this is my opinion. If you're looking to participate in the Bitcoin market or cryptocurrency market, I think the safest way to get your toe in the pool, so to speak, is to start off maybe trading a couple of contracts on the futures markets first, because at least the exchange is backing it up with a cash settlement. You don't have to worry about getting your money out versus people. I posted an article on the Market Guys Facebook page. There are people having a hard time getting their money out of the Bitcoin market. And so, again, there's a lot of gray area here. But I don't want anyone who's in the Bitcoin market to say, AJ, what are you doing? You're crushing a good thing. Listen, there is volatility, lots of it. You could make money from volatility. Absolutely. That's what traders do. But you could also get hurt very badly from volatility if you don't know what you're doing. And that's my main theme of the presentation on Thursday, is to explain to people the risks and then show them how to manage the risk once they start to get in. And those risk management principles, by the way, can be applied to any stock that we talk about even here tonight. Okay, so, all right, now, Ron, I see that you typed in F with a period and then said, would this be a good entry point? Are you referring to Ford? I'll start off with you, if you like. Are you looking at Ford? I see there's a little bit of a delay there. And let's see, would this be a good entry point? Okay, good. I'm going to start with Ron, and then I'll go right down the line. So if you type in a stock symbol, I'm going to take them in sequence. All right, now, looking at Ford immediately, what do you see? I mean, I'm kind of giving you, let me clear all these lines off because we've done some forecasting in Ford before as well. Let me clear up the chart here. You're looking at the chart. Again, I'm going to explain this to someone who's a novice chart reader, okay? Now, you're looking at this chart and you're trying to interpret the picture. What do you see on the picture? Before you decide whether or not you're going to buy or you're going to sell, you have to start reading the picture and just basically describing to yourself what the chart is presenting. Well, we obviously see there's a blue line on the chart, right? That represents a 20-period moving average. And I talked about that already, in that the rubber band effect could be applied to this stock. The rubber band is being stretched. And you can see that in the past, if I were to take a rubber band and connect one end to the moving average and the other end to the price, you could see that that rubber band is stretched pretty far away from that moving average. And the most recent price that you see right now is equivalent to back here when the price was stretched as well. You could see that the price got stretched pretty far below back in March and April of last year. Okay, so it's getting stretched once again. That's the first thing I see. The second thing that I see is that there's a gap right here. Now remember the gap rule I just talked about? 80% of the time with equities, 80% of the time and 100% of the time with the VIX, gaps fill. Look at the chart. Who can point out to me at least two, or actually just who can point out one time on, look at the calendar, the axis on the bottom. Who could tell me where there are the gaps forming? Who wants to name one area where there's a gap? James, you put in gap, but okay. Now let's see. Who can tell me where there are other gaps? May. Herschel says May. All right, let's go back to May, right? This May. Back here, I don't see any. Oh, yeah, right there. Okay, I got you. Herschel says there's a gap there. That's exactly right. Stock gap down. Let me zoom in a little bit. This is, folks, if this is the only thing that you get from me, I love gaps. I'm telling you, I love gaps. So on May 1st, the stock gap down right there. It's a small gap, but a gap down. So if I would draw a horizontal line from that gap, you could see that right here, the gap filled. You see that? What date was that? I'm blocking my calendar. So it filled on June 1st. So it took about a month for that gap to fill. So 80% of the time, yep, there you go. Now, what's the second part of the rule? 80% of the time after the gap fills, it reverses. And what did it do? On that day, it filled the gap, and the days that followed, what happened? It reversed. It went down. Who else wants to point out another gap? Let's see. James and Amalia say October. Let me back out again. Looking at October, there's a gap up. Okay, thank you. Good eye. You're all right. Exactly. Now, here is a gap up. When did the gap fill? On this day, right there in that doji. See that? It filled. What happened after it filled? It reversed. Boom, it went up. See that? There's more gaps coming out. Let's see, who else? August. James says in August. Let's go back again. August, right here. Little gap. There's also a gap. I think I saw another one recently. There's that one now. Here's one right there. Here's a gap down. See that? Now watch this. 80% of the time it'll fill. It filled, and then it dropped just a little bit, not much. I wouldn't even count that as a pullback, but we can definitely count that one as a fill. Okay, now that we know there's an 80% chance that the gap will fill, how would we play this one? Well, is it time to buy right now? Perhaps. Let's put it this way. I would much rather be a buyer of Ford right now than a seller, because there's a bearish engulfing pattern that showed up right here. See that? Right before the gap formed. 80% of the time, by the way, of bearish engulfing patterns, they move lower. That's a big one too. 80% of the time you see a bearish engulfing pattern, it's most likely going to drop. And it did. It gapped down. So we have a red candle here. We have a red candle here. We have a red candle here, red candle here. 4 red candles in a row. That's a stale red light. We're expecting a green light to show up any day now. A doji formed today, which is a sign of indecision. Dojis generally show up at pivot points. Okay? Those are key little clues that we get when you see dojis, like you see back here. So there's the doji. It went up, doji formed, it went down. Then it went down, doji formed, it went up. See that? You could see, here's another doji. Look, it came down just a little bit, not much. Came down, doji formed, and it went right up. See that? So I would be a buyer of Ford right now for a couple of reasons. I've mentioned already. There's a gap above the market, so there's an 80% chance that gap will fill. The stock is at a support level already as the volume is dropping, so the sellers are getting tired. There's a doji formed right there, and there's a stretch far below the moving average, so the rubber band's being stretched. So my forecast for this one would be boom. So if I bought it at 12, I would be looking to get out at 13, and I would put my stop right below support, right down there. That's how I would play that one. So I wouldn't be opposed to getting into a position right there, and hopefully that'll help you out, Gil. And if you do get in, just don't buy a whole bunch of it because it's cheap. Just play it in moderation. You could even use options if you like. You could sell some puts. You could buy some calls, and make sure that you get out when the gap fills, because there's an 80% chance it'll pull back after that gap fills. Okay, now I'm scanning again for some more stock symbols. Let's see. James says OIH. Thank you, James, for letting me know what your position is. Yeah, if you put a stock symbol in, please let me know what your position is so that I can help you with that. Okay, so James is long OIH at 25. Now, let's look at the picture. All right, what are the clues here? What kind of clues is the chart giving us at this particular point? Well, obviously OIH has rallied. By the way, these are all former forecast lines that I put on. Look at how nicely that worked out. Huh, amazing. So the stock broke out of resistance here. and it rallied here. It pulled back a little bit, bounced off the 20-period moving average, and now we have a green candle. Now, what does that mean when you see a green candle on higher volume? Who wants to answer that one first? A green candle on higher volume means what? I'm going to wait for an answer because I know someone in this audience knows it. Okay, who wants to be the first one a little bit? Okay, David, Gil, and Stuart all answered first. David says it's bullish. Gil says it's bullish. Stuart says buyers are moving in. Lloyd says buyers are motivated. Nathan says buyers are coming. Herschel says buyers are in control. Buyers are motivated by James. Yeah, you're all right. When you see a green candle on higher volume, it means the buyers are motivated. Now, if you own it at 25 already, here's what I would do. I would put a stop loss order. I would trail your stop up, and I would put a stop right below 28 because that low from Friday is going to be the new support level, which also coincides with the 20-period moving average, which will act as support. Okay? Now, here's why I would put a stop and I wouldn't get out yet. Now, you could see the reason I'm putting a stop in is because it could go higher, being that it broke out of this recent high on higher volume. Now, once the stock goes higher, you're then going to move your stop from below this low to below this gap. It doesn't look like much, but there's a very small gap right there. You see? I'll zoom in even more so you can see it. See, from this high, that high was 28.54. Today's low was 28.59. So there is a 5-cent gap right there. It doesn't matter if it's a 5-cent gap or a $5 gap. There's an 80% chance the stock is going to eventually come back to that gap, and then there's an 80% chance it'll bounce. So gaps, when stocks start gapping up, the gap fill points become new support levels. So what I would do is ratchet your stop up, or trail your stop up, because the buyers are motivated. There's no reason to get out now. But if you see any kind of weakness or any kind of a chance that there could be a possible pullback, at that point I might take some profit, take the money off the table, and wait for a new entry point. So hopefully that'll help you right there. All right. All right. Now let's see. Excuse me. Another stock is okay. A question came up from Gil. It says, you've compared to Friday's volume, but this was options expiration, so higher volume was expected. Well, actually, no, Gil, the higher volume isn't expected on a Friday because expiration actually takes place at 12 noon on a Saturday. And that volume is not counted in the regular open market. So it will not be reflected on there. You could say that the volume was increased maybe because people were exercising early on that day, but generally the option volume is not reflected in the technical chart. So keep that in mind. So that's a good question there. Thank you. Okay, David says CANN. David, could you tell me what your position is, please? I'd be able to help you a little bit better if I know what that is. Now, this is interesting because General Cannabis Corp took a hit with the Department of Justice a couple of weeks ago stepping in and more or less, I would say, go to battle with a lot of the individual states. States, if you're following this market, there could be a lot of money being made here as well, but you have to be careful because it's so emotionally charged that this stock took a hit when the feds came in and said that they're going to start enforcing federal laws on the states. And so states like California, Michigan, where there are illegal growers up there, they're sweating it out. Now, if you're already long this one, I would be very mindful of this gap down here. See that? And there's a couple of reasons why that level is so important. The stock is trading 752 right now. While it looks like it is bouncing off of that 20 period moving average, the volume is dropping dramatically. So you got to be careful of that. $5, that gap right around $5 is a critical point, because if a stock drops down below $5 and goes to $4.99, the margin requirement changes on that stock. And now if you're holding that stock on margin, you have to come up with more cash to hold the position. Otherwise, they force you to sell out of the position. Now, that's why most stocks, once they drop below $5, they generally drop a lot lower, because people are selling out of their positions. They don't want to bring in more money to hold on to a losing position. So they sell it. So this is a tricky one. I mean, if you're going to go long, I would keep a very, very tight stop. In fact, if you buy it like 752, I would probably get out maybe a dollar lower, and I would count my lucky stars if I got out without a big loss. Okay, so let's see. Just scanning, see if there's any follow-up question to that. All right. Now I have to go back because a lot of questions coming in with stock symbols. All right, now Alan is asking me to make any comments on the TSX, and TSX is TSX is not Morgan Stanley. It's the Toronto Stock Exchange. Hold on, TSX. Not coming up for me, Alan. I'm so sorry. Maybe this platform isn't set up for that. Yeah, I'm not. If you want to submit another question, I'll go on to Tom's Adobe, and I'll take another question, another stock symbol from you, Alan. Okay, so ADBE. Let me see, ADBE. Excuse me. Adobe Systems. All right. Would you buy Adobe or ATI? Now, what I like about Adobe is that it looks to me like there's a bullish engulfing pattern there. So I like that, but I don't like the fact that it's on lower volume. So let's take a look at ATI. I'm picking between the two. Well, this one is not giving me a convincing buy signal either. In fact, it's giving me confusing dojis here. This one could pull back. I would think that Allegheny would pull back to the 20-period moving average and do something like that, because that 20-period moving average is going to coincide with the roll reversal support level. So I would be more of a buyer in here, and then putting my stop somewhere below 26. You know, with Adobe, you also have to consider that's a higher price stock, and it's already overextended from that 20-period moving average with a gap below the market. I can't say that I would feel comfortable owning Adobe at these levels right now, Tom. Allegheny would probably be a better choice because there's less risk involved in that one. Okay, so hopefully I helped you out. Okay, Ryan is his question is, how about CVX and Chevron CVX for fan lines? Yeah, good one. All right, let me clear this one out. That's a great one for fan lines. Thank you so much, Ryan. Okay, here's how we draw the fan lines. All right, take this low and that low and project out. That's connecting two lows. Take the second or the last touch on that line, and that becomes the first touch of the new line, and draw that to that line and draw out. There's fan line number 2. Take the second or last one in that fan line, becomes the first in the next fan line, goes out. Beautiful. This is a good one. Okay, now last touch here, connected to the next one right there. Perfect fan so far. I keep doing this, and there you go. Now, what do you do? Here's what you do. If you decide to buy this because you see a nice bullish engulfing pattern on pretty good volume, which I would, you're going to put your stop right below that last fan line right there. You see that? So if you buy this stock and it drops or closes below that fan line, you get out, and then you completely reverse your position to make money on the way down, because it'll probably drop to this fan line. Okay, that's how you play that. And that's a great example. Let's see what that looks like on the weekly chart. That's an upward, if I started on the weekly chart, I could probably, could have joined another fan line back here, could have had more fan lines. But that's Chevron. And you got to understand that their profit margins are increasing right now. And another thing is colder weather, and we've had a lot of it. Colder weather has actually been helping a lot of the oil companies, because it's not just gasoline that they deliver, it's heating oil up in the Northeast too. So their demand right now is very strong, and I think a lot of people are playing that. So that's how I would play Chevron. Thank you very much, Ryan. Appreciate that. All right, let's see. Roberta says ABBV. Is that a U.S. stock, Roberta? ABBV. Let's see. Okay. That is, oh, wow, look at that one. Look at that weekly chart. This one's pretty extreme too. If I did some fan lines here, we go from here to here, project out. Let's just, for the heck of it, do that. I'll do it quickly without even explaining what I'm doing. And there we go there. You can even go from here to here, and then it gets extreme from here to here. And then I could even go in on the daily chart and throw a couple more fan line, or maybe one more fan line right there. Okay, now, Roberta, do you have this position already? You're in it at 59.27. Am I correct on that? You're in at 59.27? Okay, there's a little bit of delay there. So don't, yeah, okay, good, you got it. You're in at 59.27. All right, let me ask you, where is your stop loss order on this one? Do you even have one? You have a stop loss order, so you got in at 59.27, and if the stock starts going lower, where are you prepared to pull the trigger and get out? I know, again, there's a delay there. I'll wait for your answer, and I don't see it. Well, let me help you with that while you're typing in. You have to pick a fan line to get in, or excuse me, to set your stop. So if you're looking at this and you see that you have a good strong candle, I would put my stop either right below this most recent low, or you can go down a little bit further and put your stop in maybe around 102. And here's why. There's a good strong chance that the stock is going to pull back to the 20 period moving average. But from the looks of the most recent up leg, it could probably come down to the 20 period moving average and bounce. So you might want to put your stop below 102, because if it breaks down below this fan line, you have a much longer way to go. Excuse me, much longer way to go on the way down if that second fan line there breaks. So you got to be really, really careful with that long position. And there's nothing wrong with taking some of the money off the table and taking some profits to raise cash, to look, to be able to have some buying power to get in on a second bounce off that moving average. Okay. Okay. Michelle is considering to buy Sienna, I think, CIEN. Is that Sienna? Yeah, Sienna Corp. And looking to trade the gap. Okay, here we go, Michelle. Now, let me tell you, I'm assuming that you're looking to trade the gap up here around 23.5. Is that right? Because that's the only open gap that I see. Excuse me. All right, see, let me clear all the lines off here, because you can see that Sienna has a tendency to fill the gaps quite often, and then even reverse after the gaps are filled. It has a gap here. Look, gap back here, and then there's a gap, big gap here that ultimately filled here and then reversed. Here's a gap down that has not filled yet, so let's draw that line as a target. I think target at 24 is reasonable for that. And it looks to me like you got a bullish engulfing pattern here with a long shadow under that candle, which tells us the buyers are coming in. That's number one. Number two, this gap, this up gap, has filled already, but it has not bounced after that gap. So again, that supports the idea of a reversal to go back up. So I like that idea, as long as you're putting a stop somewhere below this low right here. So if you buy, let's say you buy in tomorrow at 22.15, maybe it opens up a little bit higher. You buy at 22.15. I would put my stop somewhere below 21.40, something like that. Give it like a 50-cent stop loss or risk per share, and I think you'll be okay with that one. Okay. All right, let's go. I'm trying to keep up with everyone. We got a lot of stocks coming in. Sean says PEGI. So PEGI, Sean is long this stock and entered in at 21.25. Okay. Now this one looks very, very similar to another stock that we recently took. Last week I put out a trade alert on ETM, and this one looks a lot like that stock. And I'll show you after we review this one, I'll show you how that compares. Now, Pattern Energy Group is showing a good, strong green candle as it's breaking over that 20-period moving average. That's good. All right. Now, what we want to make sure is that volume is increasing too. And it's slight increase. I mean, I have to say that the volume is almost flat, but it has a very, very slight increase. What I do like about that candle, by the way, Sean, is that it's a good long candle. You know, if there's a shorter candle, I say watch out. But that to me looks more like a commitment on the buy side. And the fact that it's closing over that 20-period moving average is really good. So if you're long that one, congratulations, you're up a little bit. But where is your target? That's going to be my next question to you. Do you have a target price in mind, or are you just going to hold on? Because what I see here is I see resistance up there around 22.10. So the way this stock looks, it looks like it could be a good trading stock, but because it's in a trading channel, you see this low right here is acting as support, the high resistance. So you're already halfway through the channel. I would be looking to get out on a decrease in volume up here around 22.10. And any kind of a pullback, you might want to take your profits if you haven't considered that one. Already. All right, so you have 22.5 as your target. That might be a little optimistic. I would say 22.10 is a better choice, because if you're trying to squeeze out a couple extra pennies, you could wind up losing the whole trade, because if it gets to 22.10 and pulls back, it could go right back to 21, and now you're sucking wind, because now you turn a winner into a loser, and you don't want to do that. All right. So, all right, let's look at this one. Square. This is SQ. This is Philip is coming in, SQ. And let's take a look at what his position is. It says, no current position, thinking of writing cash covered puts. With strike price of 40. Well, I don't know if that's a good idea of writing the puts or cash secured. And here's why. Because it looks almost like a cup and handle pattern here. This looks like it was a cup and a handle that just broke out. Here's the cup. Here's the handle. And so you have good, strong volume. And I think that you might want to at least wait until it gets up to fill that gap around 48. Because I think this stock is on its way to go to 48. And then you might see a pullback, at which point you might be better off doing the cash secured put, which is writing cash covered puts, because if it goes up and you're selling a put and it starts to come back down, now you're in a tough position. I don't know if there's even any premium in selling the puts at 40. Let's see. What month were you thinking about selling? February's? Let's see. February 40 puts. Now, there's not a premium in there to be selling the 40 puts. They only look like they're trading for around 42 cents. Not worth the risk, Philip, for that kind of reward. I would say. All right, so it's up to you. But the way the technical charts are showing, it could go up a little bit, but then it's going to start pulling back, and then you don't want to be long that at that particular point. Okay, D says BEAT have owned it lower, but want to get back in. Let's see, BEAT is Biotelemetry Inc. I don't know the company, but I like this pattern because this looks like kind of a weird shaped cup and handle again. We have a cup, and then you have a handle with resistance. It looks like it's almost right at that resistance. So what I would say, I would wait on this one with patience because the volume is not storming higher, and you need strong volume for it to break through that resistance point. That's number one. Number two, there's a gap up here that's going to act as resistance as well. So what I would say is it's probably better to wait for this one to pull back a little bit to bounce off of that 20-period moving average and get in somewhere around 32.10 than to buy it a little bit higher, $2 higher. That just looks a little bit safer for me to wait for the pullback because it does have a history of pulling back to that 20-period moving average and bouncing. See that? It bounced here, bounced here. It most likely will come back, bounce again, and I would say that's your best point. So, you know, you could put in a price alert for this stock, and when it gets down to 32.10, 32.20, then maybe buy in and put your stop somewhere below the 20-period moving average, and you'd be fine. Okay. All right, let's see. John has a question. What's the maximum number of stocks should I hold in my portfolio? You currently have 18 stocks. Well, with our option traders, I try not to take on more than 10, but that's because it's a subscription service. So I try not to take 10. I've gone as high as 14. And here's why I don't like to trade. I mean, if you're investing, that's a different story. But when you're trading, you want to keep the number to a point that's manageable. Because if you have too many positions, what could happen is you could have a distraction, and all of a sudden bad news comes out on one of those positions, and you wind up giving back all your positions because maybe you have 14 or 18 stocks and CMG is one of them, and and Chipotle Mexican Grill has another food poisoning incident, and one stock bashes your whole position. You see, I like 10 because you can memorize 10 positions, and with your smartphone, you'll look at Google charts and pretty much keep an eye on your positions. Again, 18 is probably the border. I wouldn't go too much higher than that if you want to stay consistent. Listen, when I was a NASDAQ trader, the guy next to me, Mike, all he did was trade one stock. He was in and out of Microsoft all day long. That's all he did, one stock. That's all he did, traded one. And he was happy with that. And there were a lot of guys that were professional market makers, and I had 50 stocks, but I had two assistants helping me keep an eye on the book. You know, it was different. And it was constant, just constant concentration. But if you want to relax with this and have fun with it, you want to keep it to a manageable position so you're not all stressed out about it. All right. All right, let's see. Timothy, welcome. All right, Timothy says ESNT. ESNT. What stock is that? I'm not familiar with that one. Ascent Group. Okay. This one looks a little overextended to the upside. That's my first, opinion glance at this, all right? You said that you're long and got in July options when the stock was 3 points lower. Okay, well, let me draw you a channel line. Here's the trend line. Start with that low, connect to that low, project out. See how perfect that is? Now, a channel line is a line that you draw parallel to the trend line, connecting some tops. You see? So there's my channel line. It's perfect channel. And now you see that the stock is at the top of the channel, hitting resistance on lower volume as it's moved quite a far bit away from that 20-period moving average. So my projection on this is that you're probably going to start to pull back on that. So it wouldn't be, if you bought options on that, maybe you could turn it into a spread of some sort. Maybe sell at the money calls, or maybe slightly in the money calls against that. Okay, this is what we do with our trade alert service. We get people into spreads. Sometimes we leg into the spreads. Sometimes we get in all at once. Okay, so that's something you can consider. And if you have another question with that, email me, and I'll try to reach out to you. I don't want to give anyone individual advice here, but I do want to make sure you're doing the right thing. Okay. Excuse me. Okay. Let's see. By the way, folks, I'm going to mention this. My partner Bill is on the line recording all this, and we're trying our hardest to do the best to educate people. We have this year we have a couple of the mentoring spots that are open right now, and if you're interested in that, just email me. These are one-on-one sessions that you have with me. The only requirement to make it worth it for you is you have to have at least 50,000 in your account to trade to make it worth it. Okay, because no sense in trading just one option contract and thinking you're going to make any money with that. I mean, you can, but you're not going to make a fortune. 50,000 is a good minimum number. And if you have that, you want one-on-one coaching with me, just send me an email and let me know. Okay, got a couple spots opening in February. All right, next stock. MU. This is Rick, coming from Rick. And let's see, MU. What's the position you have, Rick? You're long it or short it? What are you? I don't see any notes on that side there. All right. Oh, I'm so sorry, folks, for the congestion. Be coffee in your ear there. Okay, I'm going to go with Micron Tech and tell you I like the way this stock looks right now. Now, if you've taken any of my web classes, especially those who are in Canada, I've done trading patterns before. That's one that's recorded on the Scotia iTrade YouTube channel. What I see, it just kind of pops off the chart, is I see a trading triangle right here. Can you see this? So when I connect the highs, you have descending highs and ascending lows. And these are usually very reliable patterns. Now, you could see that there's a hammer pattern. That's a bullish candle, a small body candle with a long shadow underneath. That's a bullish candle, Rick. And there's a good chance that this will start to rally. And if you see the volume picking up along the way here, if you see these volume bars start growing, okay, while it's approaching the upper line, then there's a good chance this thing is going to break out. And the way you measure a breakout on a triangle is you take the distance from the high and the low here, and you just transfer it to the breakout point. So the expected price target on a breakout could be actually as high as 55 on this one, 54, 55. So that looks like a good trade setup for you. And let's see, it says like you got $48 or 50 at 48. Okay. Yeah, it could make some money for you. It looks like you're underwater a little bit, but the signs look pretty bullish right now. Okay? All right, hopefully that helps you out as well. All right, got 2 minutes left. I think I might be able to get one more stock in. Let's see. Walter, thank you. Walter, are you a repeat attendee? I don't recall your last name. If you're a first timer, welcome. Okay, AGEN. AGEN, and Walter says, had it for several years with not much change. Should I sell it now at 4 and take a profit? Actually, I would hold on to this one because this, my friend, is a perfect cup and handle pattern. Look, Google cup and handle pattern. You'll see. Here's the cup. All right, you have to use your imagination there. Here's the cup. And the top of the cup is called the brim or the rim, depending. And hold on one second. Okay, top resistance area is the brim, and then it pulled back and formed the handle. It looks like it's breaking out. It's breaking out on higher volume. So I would say get ready to take a ride on this one. Because if this one goes up, it's probably going to bump its head up against 5 and then pull back, because that's the margin requirement change. Oh, having a sneezing fit, folks. Sorry about that. So that's probably, resistance is going to be a 5, because remember, that's that border where the margin requirement changes. And so you could see something great happen if it breaks over 5. But if it pulls back, that's the point at which I would take some profits for it. Okay? So it is 9 o'clock on the dot. I didn't run out of stock symbols, that's for sure. I just ran out of time. And remember, if you're interested in enrolling in the TradeStation event, go to tradestation.com and click on their University tab, at which time, let me see if I can pull it up for you. I'll bring up a new window, and I'll show you exactly where to go on this one. You'll learn a lot, even if you don't want to trade the cryptocurrency markets. They do record it, so you could register, and then I think they'll send you the recording so that you can listen to it later on. But go to tradestation.com. We're actually forming a partnership with TradeStation, where if you're a Market Guy subscriber, they're going to give you a discount on your commissions. And if you're a TradeStation customer, we're going to give you a discount on our services. So it's kind of like a I'll scratch your back, you scratch my back kind of a relationship with TradeStation. So you go to menu, go to University right there, and it should be right on the front page of the University site. Let's see if it is. Hold on. Scroll down. Yep, there it is. Managing risk in the cryptocurrency market. You just click on that, and then you could register for the event, which is 4:30 Eastern time on January the 25th, which is a Thursday. All you have to do is put your name and address in there, boom, email address, and you're locked and loaded, ready to go. So I appreciate your time this evening. I really do appreciate your questions, the stock symbols. Hope you got a lot out of it. I certainly had a lot of fun, and I'm looking forward to doing it all over again on Thursday. So have a good night, folks. Talk to you soon. So long.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening, and our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these two questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have two services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.